Hi everyone, and welcome again to Nettle, the go-to place to learn about finance, econometrics, data analytics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. My name is Seva, and today we're investigating the Ohlson O-score model, which is an extension and an improvement, arguably, over the Altman Z-score model that we investigated in one of the previous videos. And it is a little bit more sophisticated. It is slightly more difficult to apply, but still remains quite basic and user-friendly, and quite easy to navigate with publicly available data, which is what I'll showcase today. It was designed in 1980, so 12 years passed since the seminal work of Altman, and James Ohlson proposed his own version of a model to predict defaults, to predict financial distress, to assess the financial health of companies. And here we need to understand what sort of data we might need for our evaluation. And one advantage that the Ohlson O-score model has over the Altman Z-score is that it does not require any stock market data. So if you have access to disclosure of a private company, you can still assess its financial health this way. However, for this particular evaluation, you need three statements, unlike two statements for Altman Z-score, just balance sheet and income statement. For the Ohlson O-score, you also need the cash flow statement. So you need balance sheet, you need income statement, and you need the cash flow statement. The observations, the inputs that we require are the following. So first of all, from the balance sheet, we just need four inputs. We need total assets, total liabilities, total current assets, total current liabilities. Those are the only four inputs we require from the balance sheet, and we take the most recent available values. So for, again, Rolls-Royce, the company that we have as our first example, those are year-end 2024 values. From the income statement, we just need net income, so net profit or loss. However, we require it for 2 years running. We need it for the most recent year and the previous year. So here we take 2024 and 2023. And for the cash flow statement, we just need cash from operations for the most recent year. So essentially, we just need 7 data points to evaluate the Ohlson O-score. And here we pull it from investing.com, which is a publicly available and free source of this kind of information. Before we calculate the input variables into the Ohlson O-score model, we need to calculate working capital as a difference of current assets and current liabilities. And we also need to perform the adjustment of total assets into 1968 US dollars. Again, this is to evaluate company's size, and obviously as time goes on, the value of any currency typically erodes, and to make it usable for the model that Ohlson estimated, for the coefficients that were included into his model, we need to convert total assets of a company, measure of size, into 1968 dollars. As we've got our values, our total assets in million pounds, what we need to do when converting total assets to 1968 dollars is we need obviously the current exchange rate of pounds and dollars, 1.31, when this data was collected. And we also need the consumer price index in the US for 2 points in time. For the time of total assets being reported, that's year-end 2024, and as of year-end 2024, that's the value of US CPI. and 1968 US CPI is here. So we can see that the value of the dollar has reduced by a factor of almost 10 over the 56 years that passed since 1968. So to convert total assets here, 35 billion pounds to 1968 dollars, we need to do the following adjustment. We get the total asset figure, we multiply it by the exchange rate, and we'll lock it because the exchange rate stays the same. Then we multiply it by the consumer price index in 1968, locking it again, and we divide it by the consumer price index in 2024. So we see that 35 billion pounds today is around 5 billion pounds in 1968. It's roughly $5 billion in 1968 prices. Dragging it across gives us the values for all of the remaining companies, both in terms of working capital and adjusted total assets. And now we can discuss what are the variables that go into the Ohlson O-score model. First of all, we've got the constant, which is equal to 1 across the board. Then we've got the size variable, which is the natural logarithm of total assets in 1968 dollars divided by 100. So here it's dollars, not million dollars. So what we have to do is we have to take the natural logarithm of total assets in $1 million. We need to times it by a million, so times to the 6, and divide by 100 because it's over 100. And that allows us to calculate the logarithm of total assets, so that's a measure of size. And then we have got the leverage value. Again, it's quite straightforward. The higher the leverage, the more likely is the firm to default, experience financial distress. So total liabilities over total assets. Again, here the Ohlson O-score is different to the Altman Z-score. Altman Z-score uses market value of equity over total liabilities. Here we just use book values, which is arguably less informative, but allows to apply this model to companies that are not traded or for which prices are unavailable. That can also be applied for all of our companies. Then working capital of total assets, again a ratio that measures liquidity, so working capital divided by total assets. Then another measure of liquidity, current liabilities over total assets. Then another measure of liquidity, current liabilities divided by current assets. Then we have got an indicator variable, which essentially equals to 1 if total liabilities are greater than total assets and 0 otherwise. So if total liabilities is greater than total assets, 1 and 0 otherwise. Then a ratio of net income over total assets, so essentially net profitability. We use the latest net income divided by total assets. Then we calculate the ratio of cash from operations over total liabilities. Then another indicator variable that equals to 1 if the firm turned out a loss in both of the previous years and 0 otherwise. So if the latest net income is less than 0, then if the previous net income is also less than 0, then 1, 0 otherwise, 0 otherwise. We can see that across our 5 companies, all are profitable apart from ASOS that turned out a loss both previous years. And then X10 is a ratio of change of net income over the sum of absolute values of net income. So regardless of profit or loss, it goes in with a positive sign. That is essentially how much profitability is growing. And then we can use the coefficients estimated by Ohlson. Again, in his 1980 paper, Ohlson actually provides several models with variant set of coefficients, but argues that this particular model with these coefficients is the best fit. We can see that it includes a constant, unlike the Altman Z-score that doesn't. And we can discuss some of the relationships here in terms of the size and sign of the coefficient. We can see that larger companies are less likely to default. Again, that's quite a prominent stylized fact. The larger companies tend to have an easier time raising funds, all things held equal. Then the largest coefficient here, 6.03, so again a positive coefficient, meaning it increases the chances of default. Total liabilities over total assets, so more levered companies are more likely to default, experience financial distress. Again, very straightforward. Working capital over total assets, liquidity decreases the probability of default. We have more liquid companies that have more working capital are less likely to default. That's quite straightforward. Then X5, current liabilities over current assets. Again, the greater the ratio between liabilities and assets in terms of the short term, the more likely the company is to default. Again, that's quite understandable. X6 is hard to reconcile with theory. Again, if total liabilities are greater than total assets, then it means that the O-score should be lower, so this coefficient is negative. Basically, it is simply an adjustment term. It's hard to reconcile in terms of theory. Perhaps it's to suggest some non-linearity in the relationship between probability of default and leverage of companies. So essentially adjust for that non-linearity. Then net income over total assets goes in with a negative sign, so profitable companies less likely to default. Again, very, very true. Then the ratio of cash flow from operations over total liabilities. Again, negative term, which basically means that the companies that generate more cash flow from operations as a fraction of total liabilities are less likely to default. Again, more cash flow from operations makes firms more resilient. That's very, very straightforward. Then a positive sign for the dummy variable equals 1 if companies turned out loss in the past 2 years. Again, if a company is consistently losing money, it's more likely to be in financial distress. Very straightforward. And the last but not least, the growth of net income is negatively related to financial distress and default. That's very straightforward. If the company becomes more profitable with time, very unlikely to default. Now we can finally apply the model, use some product of the coefficients that we lock, and refer to the variables for this particular company and apply it across. Now we can simply use the standard normal distribution. So unlike the Altman Z-score, where we could not interpret it as a probability, again, we just needed to use the thresholds that were specific. Here we can plug it into distribution and evaluate the probability of default. However, it's not a normal distribution, it's a logistic distribution, simply because the models that predict default were estimated using a logit model. Again, back in the day it was there for computational simplicity. Really nowadays it's more of an artifact of the time. Again, if you are interested in probability logic models, I suggest you watch these videos after this one. But that means that the way of converting the O-score into a probability is to take the exponent of the O-score and divide it by 1 plus the exponent of the O-score. If we drag it across, we see what are the probabilities of default for the 5 companies in question. And these are very, very believable from, again, just eyeball perspective. It's, again, quite straightforward that ASOS is the riskiest of them all, given its business model and given it turned out the loss. whereas the remaining four companies are quite stable and are unlikely to default. Again, the probability around 1% is again quite believable for large UK companies which are not experiencing any major financial trouble whatsoever, and that's what again makes the Ohlson O-score arguably a better model than Altman Z-score, given it encompasses more fundamental information and it's less rigid in terms of what it tries to do, and it does not again have those false positives like with Altman Z-score. BT Group was flagged up as a problematic company with a high chance of default, whereas here we see that it's not the case for the Ohlson O-score. Still, Ohlson O-score, albeit being newer than Altman Z, is still 45 years old. And again, those coefficients might have changed since then, and some other variables might have entered the equation that are relevant for credit risk assessment. Also, if you think about international replicability, various markets might have their own quirks that are not accounted for in this model that was based on the US sample. While Ohlson O-score is more generalizable and more robust to the passage of time than Altman Z-score, arguably, and it is more easily interpretable as a probability, so can go in a wide range of different credit risk models, which is helpful. It's still better to take the outputs of the Ohlson O-score with a pinch of salt. And that's all there is for the application of the Ohlson O-score in the modern context, real world data on UK companies. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos you would like me to record. And please don't forget to subscribe to our channel. Thank you very much, and stay tuned.